So you've heard rich people pay no tax, right? Well, whilst that's not true, they are incredibly clever about how they structure their businesses. They pay no more tax than they need to. So today I'm going to show you how you can do the same. So your business structure matters. Get it right and you get to keep more money. Get it wrong and you could be paying more tax than you need to. And as a small business accountant, my team and I spend all day long helping small business owners on their journey. And as you can imagine, making sure our clients only pay exactly the minimum amount of tax that they legally need to is a key part of our day job. So today we're following a business owner called Marie to show you exactly how smart entrepreneurs organise their businesses to not only save tax, but to protect cash and scale efficiently. Marie has a day job as a marketer. She started a side hustle offering marketing consultancy. It's growing, so she's leaving her day job to go full time. And like many owners, her goals, freedom and more income. So she wants to keep as much of this money she's generating as possible. But she's worried. She's wondering, how do I avoid paying too much tax? So first she was thinking, should I stay sole trader or should I go limited? She started off self-employed. So here's a quick reminder on the tax difference. So as a sole trader, you pay tax on everything you earn up to 45% income plus national insurance. There's no legal separation between you and the business. So if the business runs into trouble, your personal assets are at risk. Super easy to start, but this structure gets more risky as your business grows. Now on the limited company side, the company itself is its own legal thing, so it pays its own tax, what's known as corporation tax, somewhere between 19 and 25%. You then decide how you want to take the money and when, through things like salary, dividends or pension contributions, and you're going to pay some tax as well on what you take from the company in those items. But your personal assets are protected and you get full control to plan your taxes strategically as your business grows. So Marie ran the numbers with her accountant, who's of course a pro and knows the ins and outs of business tax. She'd heard limited companies save a load of tax and was worried about missing out by not doing it. So firstly, they did a comparison on what £40,000 profit might look like in the first year and found a straight 1 versus 1 comparison. There wasn't actually much difference. But once you reached a certain level of profits, the limited company starts to make a real difference on how much she actually takes home. And that's because you can do things like leaving profits in the business, taking dividends, optimizing other allowances, all things that sole traders can't often do. And she learned during those discussions that a few years ago, limited companies were awesome, very favorable for tax treatment. But recently, changes from successive governments have really hammered this, and making that switch can feel a lot riskier now if you don't get the right information. And her accountant showed her that getting this right isn't about one simple trick anymore, it's more a combination of smart moves. So we ran through the numbers for the next year, presuming that all went well and that she made even more money, showing exactly how she could maximise her profits. So they looked at a scenario where she had a fantastic year and actually made £100,000 profit. He showed her that tax bill using the limited company example and what it might look like if she took all the profits out in 1 year. They worked out the best thing to do was pay her a small salary and then take the rest of the profits out as what's known as dividend. That's payment of the profits to you as the shareholder. This meant that the company itself had a tax bill of $19,000. He showed her what the tax bill for the limited company and her personally might look like if she took all of that profit out in 1 year. And that's paying her a small salary and the rest is coming out as profits, what's known as dividend. And that meant that the company had a tax bill of £19,419. And she had a personal tax bill on those dividends of £13,484. So a total tax bill of £32,903, so nearly £33,000. They spent some time discussing Marie's situation and that she had a couple of teenage kids and also a husband who's currently out of work, and they looked at involving her family with the business. So then what they did is this. Firstly, the timing of all the different personal allowances, and with the new tax year on its way and them all getting reset, it made sense to pay her and her husband a small salary. So she liked the idea of the husband being part of the company and owning some of it as well, so she gave him some shares. And also she had 2 teenage kids and they wanted to help with the social media scheduling for her clients and actually carrying out some work. So paying them directly made more sense because this is also going to be tax-free because they've not got any other income. And by paying the husband and the kids, they're all using up their UK personal allowance. Now, you might actually pay them slightly less than this, but this is just for example purposes. And you might think, well, why does this really matter? Well, she was already putting her hand in her pocket for the kids all the time anyway. They always needed something. And if you imagine the money to pay for the thing has already been taxed by the company, and then she's paid income tax on it. She's already paid 2 lots of tax on it to go and buy the thing for the kid. In this instance, the company paying them directly means not only do they get their hands on the money using their tax-free allowances, but the company gets a tax deduction itself. So it made far more sense to be tax efficient with this and have the company pay them directly. And what this meant is they were able to get all of the salaries out to the individual members of the family, and they're fully tax deductible. So after that, once Marie has paid the company tax, there's some money left for dividends, and that can be split between her and her husband. And that's possible to be paid in dividends because they both own some shares in the company. So the tax bill for the company is now at only £9,447. And here's what each of the members' tax bills looked after this strategy. So we've got Marie at £1,718. We've got husband at £1,718, And we've got it at 0 and 0 for the kids, because in this example, we've not paid them any more money than their UK personal allowance. And presuming they've got no other income, we're at nil tax. So you can see the total tax bill of the company plus their 2 individuals is a mere £12,883. Now, if we take that versus our previous example, which was around £33,000, that's a £20,000 tax saving by involving the family, and that's just a small example of some of the things that are possible. And then you can take it a step further. You can go beyond salaries and dividends. So for example, Marie could use smaller everyday deductions like company mobile phones and other business expenses to further reduce this tax bill. And these are expenses, again, that the family is already paying out. They're already a family problem. We want them to be a company problem. So for example, if they've all got their own mobile phone contracts, when the time came around to renew, perhaps the company could take those contracts and supply the phones, and it would get a further tax deduction in this list here for those monthly payments. And there are tax exemptions that meant the individuals don't get taxed personally on it. So with this in mind, Marie was really keen to understand if she started to do really well, how she might continue this tax efficient journey. So they ran another scenario to see what this is like if she had a really strong year and the business brought in some excess cash and she was sitting on a lot of money. So at this point, she's got some excess cash she doesn't need, and she's looking to get the most of her money and also, of course, reduce that tax bill. And I presume that they've carried on doing exactly what they're doing before, with everybody getting paid, maybe some small tweaks, details of which I'm not going to go into in this example because it's not that important to the concept. But what the accountant suggested was a clever change, and that's introducing a holding company. So this is Marie's current company. We're just going to call it her trading company. And here's how it works. So this is her new holding company that she and her husband now own. And this holding company owns Marie's trading company. So the first thing they actually did was have the trading company that's got all the excess cash pay a £50,000 pension contribution into Marie's pension. They did this via something known as employers' contributions. Now, done that way, this become fully tax deductible for the company and saved £12,500 in the next corporation tax bill. And it wasn't counted towards her personal income, so it didn't affect any of her allowances. Now then, with the excess cash that was left in the company, they're able to pay those profits upwards to the holding company via a dividend. Because the company now owns the shares, you can pay a dividend up here. And this dividend doesn't have any further tax consequences on it. It's actually effectively 0% when it arrives in the holding company because you've already paid tax here. Marie then could use the money in the holding company to invest the cash. So she could do things like buy property. Or maybe actually what she wanted to do was set up another company that owned property, and we're going to make this into property business. Sometimes this is referred to as an SPV, a special purpose vehicle, and often you see things like property developments where they have a company just for development of one property or site, mainly for commercial risk. And then again, if this SPV then goes on to make some money later on down the line, it can do the same as the trading company did, and it can pay its profits up here in dividend for the holding company to use. And often you might hear the term subsidiaries, and that's what they call these companies that are under the holding companies. It's a bit more technical than that, but you get the point. Now, Marie might also decide she's going to start a new company in a different sector. So perhaps she's become a business coach. After all, she's done well herself. So she could open up an entirely new trading company under this structure as well. And again, it's owned by the holding company. And again, the same thing, when it made some money, it could also pay up some dividends in profits up here as well. So all the money can flow through to the holding company and then be used in a bit more of an effective manner. Another option Marie could do is, as the portfolio grew, she could have the holding company become almost a management company and charge fees for its services of running this whole portfolio centrally to all the companies underneath it. Now, the benefit of that is that these companies would get a tax deduction reducing their tax bill because the holding company would invoice them for that cost and they pay it up each month. Now, of course, the holding company would have a tax bill the other side for that, but it's likely that it might have other tax deductions in the company to offset that. Now, the detail of that, though, is probably outside the scope of this video, so we'll leave that for another one. But this is the same strategy that big businesses use to protect cash, reduce risk, and stay tax efficient. And hopefully, as you can see from Marie's example, there are plenty of opportunity to save tax even as she grows, just by playing around with the structure. And all of this is legal and structured to save tax while preparing that business to scale. Now later, if she becomes mega wealthy, she might start to look at things like where she wants to live and where she wants to be tax resident. Now, whilst this is outside the scope of today's video, I couldn't not mention it because of course you see chat and you hear about owners leaving the UK for countries with cheaper tax rates. So I did just want to have a few words on this. And look, while some owners might do that, in my job we get inquiries from non-UK owners all the time looking to do the reverse and set up here. And that's because the general business environment in the UK is seen as something that's stable and the tax rates are okay. So the UK is still seen quite often as desirable. And look, if you're chuckling at that and thinking, I don't care, I'm off, I'm going to go set up in another country, then the main thing with tax residency to understand is it's not just simply a case of starting up another company in another country. In fact, it's highly unlikely you just be able to open a company in another country whilst doing your whole operation in the UK. It's just the way the international tax laws work. But if you are serious about moving abroad, get some good tax advice. This style of advice, though, doesn't come cheap, so be sure you're serious curious about how much cash you're looking to invest to find out the answer. Now then, following on to this, where do the super wealthy take this even further and seemingly pay little tax? Well, when you get really wealthy, you also get into a zone where things like your shareholding or these properties you're buying in some of these companies, they're all valuable assets and you can borrow money against them. And when you borrow money, that money that's coming in as a loan is not taxable. Of course, you still need to figure out how to fund the repayments, but this leads to quite a tax efficient way to put your hands on lump sums of cash that aren't taxable as income. And then of course, you might start looking at how to keep more of your money in your family through the generations using things like trusts and those sort of things that protect you from inheritance tax. And in fact, you don't have to be particularly wealthy to start looking at the inheritance tax position. In Marie's example, she might start looking at it when one of her companies starts to get a decent amount of cash, for example. Certainly, as she got towards multiple companies, she should be thinking about those kind of things. So as Marie grows, she sees that tax efficient structures aren't about avoiding tax. They're about paying only the right amount of tax and no more. And alongside that, protecting her personal assets, using the allowances for things like pensions and how she could utilize her family wisely, and just planning for future growth and investments in general. And the key thing to remember is that all super wealthy people do pay tax. I mean, I've always said, if you've watched any of my content, that tax is a success fee, so successful people will pay it. What they're often able to do though, through clever structures like this, is just pay a far lower percentage of tax versus what they would do if it was just paid income. The actual pound figure of tax is still eye-watering in many cases, just a lower percentage to the money they're actually using and receiving. So for Marie, she can start and scale towards these strategies as her business grows. So as you can see, structure matters, and for many of you starting out, sole trade is absolutely fine. And then once you start growing in profits, so maybe you get to £40,000-50,000 profit, you're looking at considering a limited company. Then maybe as you get excess money, you're thinking about, could I invest in property? Could I top up my pension? How might having another company, an SPV, how might that help? And then if you're one of these entrepreneurs that loves to get involved in new trades, you might start a new business entirely and build that into your structure as well. So you might have multiple ventures. And when you do that, this holding company is often a key piece of that puzzle. So as you grow, think about your structure and hopefully you can enjoy the same tax benefits as these rich owners. And if you want a step-by-step guide on many of the topics we've covered in this video, hit subscribe and check out the next videos.